welcome to the Capital Discussions Trading Group 2. Today is Tuesday, April 28th. And small turnout so far, but hopefully people will be trickling in. So we were just talking about the Feds tomorrow. I just got flat on my position, so I can cruise through the Fed meeting, no problem. How's everybody else doing? You know, Tommy said May's been a good month for you.
Yep, it's been a good one. Like I said, I'm not gonna get greedy here. I'll probably start peeling off some positions this afternoon, and I'll make sure I'm flat tomorrow. And but I definitely want to be out if I can by the end of the week, pretty much with everything. Like I said, I'm going to be going on vacation here shortly, and I plan to leave my computer at home for this vacation and not think about options for a week.
That'll be a pretty good vacation.
I'll be thinking about margaritas.
So do you mind showing us your positions just so we can get a visual of what you're doing?
Sure, absolutely.
Okay.
You know when you can see option view?
I see it loading.
Okay.
Yeah, there it is.
Okay. So I'll just run through them. I have, I think I have 5 made positions in the rut still on. This is the first one. It's an M3. I'm starting to kind of flatten this one out, taking off upside risk and give myself plenty of room to the downside in the anticipation that if I decide to stay in through tomorrow, I want to be able to not worry too much about a big move. My position right now, you can see the strikes here, what I have. I started rolling back. I had more up here at 1250. I'm taking them back to 1230 now. I think I'll stay at least 20 to 30 points below the market with those. So, and I'm also starting to roll down some of the puts, which is why it looks like this. Basically, I have no upside risk other than profit at this point that I could lose, but I can't lose money on the trade, and I won't lose money on this. Like I said, I'll probably start peeling this throughout the day and getting it to the point where it's reasonable profit up here and the risk gets bumped back further. So I know I'll be sacrificing theta at that point, but I'm getting close to my profit target. This was sized a little bit larger. This had about a $70,000 planned capital. I don't use the 50,000 per tranche like John does. I think that's very conservative. I tend to use 35 or 40. I just pay a little bit more attention to where my long puts are below the position. You can control your capital pretty well by rolling them periodically if you need to. So this one is getting close. I may just take this one off, but it really depends. I'm looking at all my positions in aggregate. So the second position looks like this, and I did start peeling this one. Again, taking off upside risk, leaving myself plenty of downside room. This one I may do a little bit more with, but I'm pretty comfortable with this position right now for tomorrow. So this might be one I would leave on. Here's another one. Again, this one I have also started to peel off too. Upside risk is nil, and leaving myself plenty of downside room. So see how this one goes. Both of these last 2 positions had planned capital of about 30,000 on them, so they're getting close to that 10% number. So we'll see how that goes. Then this is a trade that I do monthly. Typically put it on around 28 days. It's a broken wing butterfly on the rut. It's small size. I size it around with a max capital, planned capital about 10,000. I'm looking to make 10%, and it's behaving, and it looks pretty good right now. So it's pretty close. And the last one I have is another M3. This one was sized at about 75,000 in planned capital. Again, it looks pretty good. Started taking off some upside risk on it, and I'll probably tweak it a little bit more throughout the day. I don't want to give much back on these at this point. It's been, like I said, it's been a good month. I'm not going to get greedy.
Hey Tom, can you go back to the very first trade you showed? I have a question that is, I think, relevant to all of these positions.
Okay. Here's the first trade.
With regard to your management, yeah. When you say take off upside risk, are you mainly doing that by moving the top puts down?
Yep. So first, let me show the graph. This is what I have, and then I'll show you my T-log, and then I'll show you what I've done there. Here's the T-log. So you can see today, I rolled back, I did a condor roll, 6 lot of condor rolls. I rolled my 1250 puts back to 1230, and I rolled my 1280s back to 1260. So that's taking up upside risk and getting most of my short strikes now at 1230. I still have a few stragglers. And then I did a few extras here this morning, 1250, 1230 rolls, again, just to kind of adjust my deltas a little bit. So that's what gave this position more of a butterfly with a single pink. I still have a couple of puts, a short put sitting right here, but virtually they're all right here right now. But by rolling back the long strikes and the short strikes together, I'm really reducing that risk.
So you're rolling sections of the position down.
Exactly.
Okay.
Yep. And I haven't messed with the puts on the downside. They've stayed there. So I'm getting closer to those, taking off risk to the downside, and I'm bringing my long puts on the upside in, which is reducing risk to the upside. I started doing that more and more. I look at the trade-off, and there's still two more 1300s sitting here. In my next move, I'd probably take these guys and roll them back to here at a minimum. And that, again, further takes off upside risk. And the way I look at that from a standpoint of risk is, right now this is trading at $44.28, so that's roughly 16 bucks. So every one of these I move, I'm taking out $1,600 of risk to the upside.
And if you have a deterioration of your short delta, then you manage that by, say, moving some of the 1250s down also, so that you
yes.
Let's see. Yeah, you're going to have to buy in those to get a little short delta.
Right. You can see I go from 60 to 25, and yeah, if you just go in here, then just do maybe one of these, and you can take it down to 40, or you do all three at that point. That's actually too much. What do I do? Yeah, I would. I thought the deltas just changed drastically here right after. No, they stayed at 60. So yeah, you can control. Yeah, you're exactly right. Just roll those accordingly. If I want to pick up some more short delta, just do that properly. So. And
it also brings the gamma down, which is good this time of the month.
That's exactly what I'm trying to do. I'm looking at that gamma. My gamma was pretty high I had so many short strikes at the money or near the money, and I just wanted to get them rolled back and reduce my gamma. My gamma was quite a bit higher before I started rolling.
Gotcha. Yeah, that's not an adjustment that I have in my quiver right now. I have to model that and see if I can fix it. I must get too high.
Sometimes it goes contrary to your Greeks, and you have to. And I've tried to live with it. Like right now, I look at this, and this morning these were trading for $18. I could have taken one of these and rolled it back here for $18, or it was very close to it. It was $17.90. I think I put an order in for $18, which basically takes out $1,800 of risk for onto the upside. And then the market reversed, and now the rut's up before it was down, I don't know, 10 or something. So this never got triggered. So it would have been nicer to do it this morning, but there's only $2 difference, and I'll probably let it sit here and see where. I mean, the market seems to be moving around back and forth quite a bit every day. Yesterday was another day where it was up 10 in the morning and then down 15 by the end of the day or something. It was all over the place.
Yeah, it's a bit squirrely. It's a bit squirrely for sure.
Yeah.
And I was having trouble getting filled in general.
Yeah, I did a few adjustments, not too much yesterday. I did reduce position size a little bit in actually this trade here. My other M3s. This one, what I did on this one yesterday, I basically took off 4 butterflies and a call to reduce capital.
So that doesn't have a long call anymore, right? It's just
it has one long call left. It was double size.
Oh, it does.
Yep. So there's still one call left.
Okay.
Yep.
Tom, this is Luis. I have a couple of questions, but it has kind of
Sure.
things in there. The adjustments that you just showed there here in the very first position, what is the trigger for that adjustment? It is a risk control, it is an opportunistic adjustment because the underlying is moving in a certain direction, or it is because you want to get a particular credit on that roll that you do and if it's a combination of all of the above, which one do you give in the most weight for that?
Every point you said is yes. That's all the things I'm considering when I'm looking at making those adjustments. And I guess it depends on, if it starts getting closer to expiration. One of the things I like to do, and Curtis mentioned this, I try to reduce my gamma while I'm making these adjustments. So I'm starting to roll my short strikes away from at the money, which is why I started getting rid of these 1250s, getting them down to 1230. But when you start doing that, then I start pulling in my puts to the upside again to reduce that upside risk and just to bring the deltas back in line. And it is somewhat opportunistic. I am looking at, what these rolls are going to end up doing to my risk on the upside, and so I'm ultimately, where I've gotten myself in trouble in the past with these is you make adjustments, the market whipsaws, and then you're making adjustments in the opposite direction. And I've taken more of the approach that if I'm going to make an adjustment, I'm also going to take off risk in that direction in case it whipsaws. And so far, that's worked out pretty well for me. When you have that whipsaw, you don't have to, undo what you just did. You've already kind of planned for it. And if it never happens, it doesn't really hurt you all that much. You might be giving up a little bit of theta. But to me, that seems like a reasonable trade-off.
Yeah. Okay. So and you work these adjustments throughout the day. You don't wait necessarily towards the end towards the close of the day.
I usually wait till the end of the day to make adjustments throughout the position, but when I'm getting close to considering an exit and I see an opportunity, I don't wait. So if the market opens in a positive direction for me where I can get out and the liquidity is good, I'm able to make my trades and start reducing my position size, for instance, which I did yesterday on a couple of positions. I did it in the morning. But I typically wouldn't be making adjustments throughout the day to continually correct my Greeks.
Okay, thank you. And you said that your target is, for the most part, a 10% on the planned capital.
That's
or
correct.
Just about all your trades.
I shoot for 10% on the planned capital for the M3s. This month looks like I'm getting close to it. Other months, 5 to 7% is more typical.
Okay, thank you. Thanks.
No, you're welcome.
Hey, Tom. Also, when you do these things and you get sort of unbalanced, I can't see the lower. It looks like they must be 1180s. You must have some long 1180s down there, or 1160s. Everything gets a little bit unbalanced, and the margin starts to rise a little bit. Do you ever have any concerns about trying to balance the long puts on either side of your shorts there to, if you say it's in an IRA or, some kind of a Reg T account?
Right. Yeah, I do watch it. I mean, right now this is above my planned capital, but I don't have any June positions on. I'm going away, like I said, on vacation, and I'm going to have no positions on. So I've let this get a little bit higher. Normally, yes, I would control that by, for instance, taking these 10 here and rolling them up. If you roll them up 10 points, I can cut $20,000 of margin out of it.
Yeah, for $500 you can.
Exactly. And so now you can see I'm at a little over 60 instead of 80. And if I was already getting in my June positions, I would certainly do that to free up capital. And also from a standpoint of risk, it makes sense to do that at some point. I did at one point yesterday when the market opened up, 7, 8, $10, whatever it was. I did try to roll these up 40 points. I wanted to get them, and I had an order in for $1, and it was down at 105, and it never got hit.
Wishing and hoping.
Yep, so I left it there, and if the market moved up more, I would have rolled up, but then it reversed, and by the end of the day, that spread was $3. So,
yeah. And that's why they didn't fill it.
That's right.
They knew.
Yeah, absolutely. I am cognizant of that, and I manage it when I need to or when I think the risk is excessive. But my position right now, I'm comfortable with this. Like I said, I'll do something with this before tomorrow afternoon, and I just need to figure out whether I'm going to start bailing on this or just kind of shoring it up and flattening it further.
Yeah, it looks great, buddy. Well done.
Thanks.
You mentioned that your planned capital for this trade is about 35 grand for a lot of 10. Is that the planned capital that makes you feel comfortable that you can manage the position properly, or is plus minus $10,000, or what is in your experience a good ratio that is work for you?
For me, for the M3 per tranche, 35 or 40,000 is adequate for me because, again, as Curtis just mentioned, you can control your capital by making adjustments to these puts, especially when you start doing vertical rolls and those kinds of things. This particular position was double-sized. I do have 2 calls, and you can see I have, what do I have, 22 butterflies right now. So that's why the capital, instead of being, close to 40, is over 80 right now on this particular position. But again, if I was already getting in June positions, I would have made some adjustments here to get this capital down to probably 60,000 and freed it up. But I don't have any need right now to do that. But under normal circumstances, yes.
Okay, thank you. I mean, just by the way, that's what I have been observing on my trades. With a tranche of 10 lots, I seldom go above $35,000-$40,000.
Yeah, I think that's true. When you start doing some vertical rolls over and over and over again, and you're getting the width of that short strike to your protective puts on the downside, you just got to be aware of that because that's where your margin's coming from. And at some point, it makes sense to roll up those puts, and you can control it, like you said, to stay within that $35,000 or $40,000 range for one tranche pretty easily.
And then in this particular case, you mentioned that vertical roll of 40 points that you put that for $1. That comes about, average, which is a not real average, about 25 cents per a 10-point roll. Is that what you're willing to pay, 25 cents per 10-point roll, or it's more or less than that amount?
Yeah, I've never thought of it that way. That's probably reasonable, though. I guess that's probably a reasonable number. If I'm doing a 10-point roll, it's probably in that 25-cent range, 30-cent range, 20-point roll, double that. So I think that seems to be realistic. Yeah, from my perspective anyway. Yeah.
Okay. I usually use 50 cents. And when I always have my orders good to cancel at 50 cents, and if it gets hit, it gets hit, and if not, it doesn't. And yeah. I may be leaving too much money on the table, but it's working for me.
Yeah, that's what counts. So those are all my RUP positions. I do have 2 of the SPX butterflies on. I'll show them quickly if you'd like to see them.
Oh, sure. Good. Let's see SPX.
Okay, so this is number 1. I made some adjustments to this. This starts out basically with typically a three lot of SPX broken wing butterflies, 75 points on the downside, 50 points on the upside, or some combination thereof to get a negative delta of around 20 for that size position, and the short strikes are typically 20 or so points below the money. And then basically that's all I'm doing is I'm typically doing vertical rolls to control upside. So let me go close this and I'll show you the T-log for this particular trade so you can see. Let's see. Okay, so this is the T-log for it. So you can see how I originally configured it. There's a 3-lot here. And I use iron condors on these, by the way. I like to keep my puts and calls separated when I'm doing SPX. I find the deep in the money options a little bit more difficult to fill, so in the SPX anyway. So this one started out with you can see a 1975 2050 on the put side and a 2050 2125. So that was a 75-point butterfly. And there was one of those, and then the other piece of it, there's 2, but on the upside they're only 50 points. And again, I determine that ratio by trying to get the right delta, which is for a 3-lot is around minus 20 to start. And then my adjustment. You put that on
about 6 weeks out.
I typically put this on around the same time as I put the M3 on. The intent is to have some additional downside hedging with minimal upside risk. So it's around 56 days in that same ballpark as when I put the M3 on. Sometimes the M3 goes on a little bit later, a little bit earlier, but all around the same time. Yeah, so this was 3:30 for a May expiration, so. All right, and then I didn't touch it till the 13th, and you can see that's all I did here was I bought a 2050 and rolled it up to 1275 just to cut deltas a little bit. One thing I do on this also, as I mentioned earlier, when it's opportunistic, I take out risk. So the market kept moving up, and I took my 1975 puts and I rolled them up to 2,000. That roll cost me, for the SPX, it cost $2. But so for $600, I took out $7,500 of risk on the downside. And then I did another roll here, 2050, 2075 on the 17th. I did a 2075, 2100 on the 24th. And then on the 27th, which was yesterday, I rolled up, this is a market open higher, so I rolled my 2000s up to 2025, two of them. And I also did another roll here of 2050, 2075. So that takes me to my current position, which looks like this. Here's my 1 at 2000, my 2 that I rolled yesterday from 2000 to 2025. And what I have left here, that last roll actually took out one of my spreads on the upside. And my position looks like that. So I have very little risk on the upside at 800. My target on this, for a 3-lot, my max planned capital is 15,000, and I'm shooting for 10% also on these, so 1,500. And this one is up now, about halfway there. And then the other one, which let's see here. Okay, this one I traded double the size this time. This one's looking good too. I've taken out all the upside risk. Same methodologies. I'm just doing debit spreads on the calls if the market continues to move up, and then I'll bring my short puts up behind the position to control my risk on the downside. So even though I have more spreads on in this, I have about $10,000 of risk in this, and this position is looking really good right now. It's up about $2,000, and my target would be $3,000 on this because it was double sized. And that's it for that trade.
Thanks, Tom. Any other last questions for Tom? If not, so Tom, it does look like May's shaping up to be a good month for you.
Yeah, and like I said, I don't want to blow that, so I'm going to probably start peeling positions here later this afternoon when the liquidity is good and the pricing seems reasonable. I'm not going to force it. Worst case, if I can't get the positions off, I'll flatten them further and reduce risk going into tomorrow afternoon.
Sounds like a good plan. Does anybody else have any trades that they want to go over or discuss with the group?
I've got an M3 that I would love everybody's input on. And I see Dave is here.
Yeah, so Dave, we saw your name on John's website now, so it sounds like you're doing some coaching there. That's great to hear. Congratulations.
Thank you. Can you hear me?
Yeah, barely. It's kind of low.
Okay. You can see my screen?
We can, Ralph.
Okay. This is I got into this trade later than the traditional. I think I got in about 35 days. And needless to say, it's been running me around in circles. This is my current position. I've got quotes suspended, by the way, because of data feed issues and slowing down with cost. But what I'm looking at is I'm comfortable with the downside where I'm sitting right now. But I keep looking at that beautiful graph of Tom's, and is there anything I can do to bring this upside flatter and still maintain my downside?
Can you show the matrix again, Ralph?
Sure.
one thing is, Ralph, when you start it later than this, you're always going to have a little slopier gamma. You see how high your gamma is?
Oh, definitely. And that's the thing that I've been fighting against. Well, let me just show you real quick. This is a June that I entered a little earlier. And, I'm thrilled to death with that.
That's more like it, isn't it?
Looks great.
That's a golfer's kind of graph.
Exactly. But this one is one that is just kind of really bugging me. Last month I got into a situation like this, and I ended up condorizing, actually turning it into an iron condor, and rode it out to the end and made a couple 3% on the thing. But I'd like to take this thing into next week, but I'd like to have something to give me a little bit of confidence up in this direction.
Ralph, let me suggest try rolling, if you can model this, roll some of your 1280s back to 1270. I don't know, let's try 5 of them.
All right.
And then roll some of your 1250s. Let's put 5 1250s back to 1230. Plus 5 minus 5, yep. Nope, yep, there we go.
Okay.
Okay, that's too much negative delta now.
Yeah.
So change. Let's look at the graph first. Just take a quick peek at the graph. Okay. All right, let's go back to the. So let's change the downside to plus 3 minus 3, 1250, 1230. Let's see what we do here now. 52, getting better. You cut your gamma some.
Mm-hmm.
You're gonna give up theta as you do this, as you can see, and you're gonna be less negative vega. But you will be, if you go back to the graph now, you probably have a little bit less dip in there, a little bit.
I do. Yeah.
And so that's kind of the methodology that I apply. I try to find what's comfortable for me to minimize that, and you can further adjust this by just playing on rolling those upper long strikes in to reduce that risk to the upside, so you can try 6 or 7 or 8, and then adjust and then get your at the money shorts further away, and that will help reduce your gamma, and that'll help flatten that line. The trade-off is always trade-offs is you'll still have the good for the most part, good downside protection, but your upside profit potential will be more limited.
Okay. All right. I feel good about where I am in the graph. It's just this area in here has really got me bucked. It's been niggling at me. If and it never will. If it stayed right here, I'm happy as a clam. But I really wanted to try and push this out a little. And I've noticed your graphs over the past period of time have always looked so nice. And so it's the tweaking that I'm not familiar with.
And Ralph, you really don't need to do anything to this trade. It's not a huge trade, and if we run up to the upside, you can always move your short puts up, and do other kinds of adjustments. But beware of over adjusting this trade, because that trade is not in trouble, and that upside is not something particularly worrisome to me. You can tweak it and stuff, but you're always sacrificing. You're always giving up some, declaring some losses when you do a roll like the one that Tom uses. You have to. It's great to be in the trade a little longer and be up money at this point, so that you don't mind the negative cash flow of the roll that he does.
Yep, absolutely. And I second Curtis that this trade is not meant to be continually adjusted. Just works best for me is don't even look at it except once a day until you start getting closer to expiration.
I agree, and Dave will attest to the fact that I'm the constant fiddler, and that is a downfall that I have that I fight against. But anyway, those are really good suggestions. I appreciate you you taking
Hey,
the
Ralph?
time. And yes, yeah, Dave.
Hey, how's it going?
Good. How about you?
Good, good. So if you're willing, I can maybe give you another thought,
Sure.
just for fun, especially if you're really trying to, if you had visions that we were really going to take off to the upside. There's something else you could potentially do. I mean, all these suggestions are all depending upon what you think the market is going to do, obviously. But let's try one thing just for fun, just so you can see something a little different.
Okay.
So, where's your long call? Okay, so why don't you take that off, and then roll 10 of the 1280s back to 1270.
Huh.
So, this is something similar to what Tom was saying, but it basically depending upon what you want to do to the upside, you can actually even move if you want. You can move. So let's go back to the matrix for a second, and you could. I mean, just for fun. This is just for playing around. So instead of plus 10 at 1270, do plus 5 and then do plus 5 at 1260. Let's just see what that looks like. So this, as you can see, you're getting benefit to the upside, but obviously your downside is getting, you're losing your advantages.
Right. Exactly.
So just like with anything else, there's no free lunch, but we like to try to get as free as possible.
Exactly.
So the thing is, if you said, hey, I really am concerned about upside movement, and you really want to kind of control what was happening to the upside, or you didn't really want to worry about it too much, and you felt that 20 points or 25 points to the downside was okay. This is just another way of, if you're in a trade and you just want to be able to kind of protect yourself to to basically minimize what potentially could happen to the upside. It's just another another way of skinning the cat.
All righty. All righty. All good suggestions. I appreciate that.
That one, especially if you're right towards the end of the trade, actually works nicely, because you could, if you're concerned about the upside, but you want to take advantage of some potential big move to the downside, it gives you the ability to kind of hang in there for a while.
All righty. Okay. And as you know, Dave, I tweak things too much. That's one of the things that I've been trying to get away from. So I'm trying to go cautiously with this.
Yeah, as it turns out, Ralph, your position literally is exactly mine right now.
This one right here?
Yeah, your existing position.
Condor structure? Okay.
Yeah, I'm not sure about the long call, but the body, the puts are exactly. I've got exactly the same thing on, and I'm feeling pretty good about where it sits right now.
Okay.
Although yesterday I was concerned when we hit 1275 that we're going to have to make an upside adjustment, but then of course this morning we're concerned that we're going to have to make a downside adjustment.
Yeah.
But
I did roll 5 puts down yesterday. My deltas were up about plus 70, so I rolled 5 down and cut it down to into the mid 30s. I think is where I moved it, or maybe even 20. But by then, the end of the day, it had gone back actually to negative delta within that half hour. I mean, I didn't do it till 1:30. And like Tom said, I've been trying to look at this thing and just touch it once a day and not fuss around with the stupid thing.
yeah, as compared to last week where basically nothing happened, take a look at the first 2 days of this week. Yesterday we had a range of over 25 points. Today we've had a range of over 16 points. So it's definitely more, it's definitely more exciting this week. So,
the older I get, the less excitement I want to have.
I hear you. But, sometimes, but I think right now where you're situated, if you can kind of, this is where a little bit of, I guess, taking a look at where the market is and what everybody else is doing and, all the other indexes and stuff, I think this is where you are right now is, actually, to be very honest, I wish we were up to about, me personally, I wish we were up around 1270
Uh-huh.
because it's,
Yeah, sitting right in the corner.
yeah, because it gives me more room to the downside, and I know to the upside I can control it very easily. I have more fear of trying to control it to the downside. It's just more work.
Yeah, yeah. Well, that's for sure. And
More work, and also
yeah.
you're more susceptible.
Yeah. Well, and like I said, this one, I put this on at about 63 days, if I remember right. And I have come to the conclusion that I'm much happier, as you mentioned, Curtis, going along with a little longer trade, at least in the beginning stages of doing this trade. I just, I can do this one and sit out on the porch and not have to do anything without even having to look at it. So.
Yeah, you can be a serious hobbyist with that trade on.
You got that right, Curtis. Okay.
Ralph, you can take some nice long drives, and you won't even have to worry about your position.
Oh, exactly. I can hit McDonald's 4 times a day and not have to worry about it. So. All righty. Well, Tom, Dave, and Curtis, thank you for the input. I appreciate it.
Sure, buddy.
Yep, anytime.
Does anybody else have any trades they'd like to go over? Or get some input from the group?
Tom, if nobody's got anything immediately, I can show you briefly what I ended up doing in that CVX Chevron thing last week. Went over some ideas for.
I did buy a put last week when we talked, Curtis.
Did you? Oh, you bought a put?
I'm sorry. I sold a put. You know me better.
Okay. Yeah. Who buys a put?
Yeah.
Okay. Can you see my Thinkorswim, Tom?
Yep, we can.
Yep.
Okay. We had been trading up to this 110 area, and earnings for CDX are on Friday. So I was looking for a way of taking advantage of some of the great volatility for a stock that is, the volatility is going to go down. So what I ended up doing is selling the 110 straddle in May because I anticipate these volatilities backing off. And I also bought these calendars above the market. They were really, really cheap, 48 cents a piece. And I know that this 115, I had a 2-point, I think when I actually did it, I even had more than 2 points positive skew in the volatility there. So for 48 cents a piece, I had these calendars, and I know that this is going to come up, this T+0 line when the volatility comes out of the May on Friday after earnings. I know I'm going to get a little bit of a bump here. So the calendar, even though it the whole tent is up above the price, felt fairly safe because of the great skew there. So I have an aggregate position right there that has, a decent upside potential going into expiration. And then, the straddle is not going to make as much money up there, but I have a full 5 points, a full like almost 5 or 6% here of movement, that I can take advantage of. And of course, the straddle will play out on Friday, and then I'll just be in the calendar. And, I'll probably just get out of the whole thing. If I can make $500-600 on $6,000 of capital, that would be fine with me. And I did a similar thing in Apple yesterday, where, using different things, I came in and did a diagonal, because I liked the long-term upside and the short-term downside protection. I had about a 7-point positive skew between the May and the June, and that's come out already. So, I've got just $400 of upside. And then I have a calendar in the May 1, May 5, which is also up decent money. And, may just take this off now. But that's an example of an earnings play that worked out fine. Used to be you couldn't trust anything about what happens to Apple after earnings, but the past few earnings, it's been a lot more stable. Here it came down right at earnings, and then gapped up, so it had about a 5-point movement. Back here, it just kind of drifted up here, maybe 4 points, and back here drifted up about 3 points. So, with this position on, I had plenty of protection on both sides of the market price. I think it closed about 130, 150 or something before, and their earnings came out about 430. It ran up to almost 130, about 134.50, something like that, 34.75. What was it here? 134.50. And then it came back today, into this range here. I could probably hold on to this position, but I have, a decent amount of profit in it already. And, I'm pretty much a person that does better taking profits early rather than, getting an ulcer trying to squeeze another $200 out of this thing, which I don't think is worth it. So I'll probably get out of this thing today. But it just, worked out. I don't have any other earnings plays on. I have the CVX, and that'll probably come off Friday, if not today. I have this upside potential, and I may play with it because it's not a serious amount of exposure. But earnings are Friday, so if I start feeling a little ambivalent about it, I might just take it off for $300 profit. But those are both, decent little earnings plays for the boring mind, the idle mind. So that's it.
Curtis, I have a question.
Yeah.
If you do this type of earnings play with tickers that or have a certain volatility skew, or you do that with just about everything that you think is going to happen? Like for instance, with Netflix will have been kind of a problem. I'm curious if you did that particular one, or how will you have handled Netflix, for instance?
That's a great question. That is a really good question. And I used to play with stocks like Apple used to act like Netflix. When Apple was a $600 stock, it acted a lot like Netflix acts now, and Netflix has had these huge moves. So I just don't trade it I don't trade Netflix anymore. It has too much movement. And if you can get decent skews, look at these moves in Netflix. I can't handle that. It's too much for me. It went up 100 points. From this support level here, went right through it, the resistance, and now this is probably a new support level up here. You get these great roll-offs of implied volatility. But the price movement it makes it too dangerous. Did you find in Netflix that the price movement was outstripping the benefit you got from selling the high vol premium month? Is that what you're saying?
No, I got my butt kicked badly with Netflix a couple of years ago, and I said, the heck with it, I'm not touching it anymore. I was a bad beat. I think that was a $5,000 bad beat that I took from Netflix.
Been there. Happened to all of us, buddy.
Oh, yeah. But I was curious to see if you play that one or not.
Yeah, the skew is so juicy. It's really tempting to sell some of that front month volatility feel like you're going to own a very valuable long call or something going forward. But it's really upsetting when it gets so underwater, you know. So, you know, with Apple, I know the Apple stock, and I, you know, I'm always looking at it, looking for some way to play it. And, you know, honestly, I was just diddling around midday on Monday and saw that volatility, you know, about a 6 or 7 point volatility skew between May and June, and I thought that was a good thing. So I am familiar with Apple. I think that was part of your question. I am not familiar with CVX, but after reading the article in Futures Magazine, you know, where they talked about how this stock and other stocks like it, these large cap oil stocks, have only come down 20% when the price of crude has come down 50%. So when it goes into a channel like this, when it goes into a trading range, that is where my comfort is. You know, it's been in this trading range since the beginning of the year. So, you know, I just felt like I could put something on that took advantage of that trading range, you know. But I'll probably chicken out of this too, and, you know, if I can get out of it for $400 or $500 in the next 24 hours, I'll probably do it. You know, even though there's, you know, a good $1,000 probably in the trade without much risk at all.
That's pretty good, yes.
Yeah.
I try to do those type of trades with butterflies or diagonals, but I never tried the combinations that you have here of straddles and calendars. But as I said, you know, I just didn't dedicate too much time. I did pretty good in some of them, but you know, after that bad beat, I stay away from those ones for the time being.
Yeah,
I wonder if you have tried to do something with butterflies, for instance.
Yeah, and, you know, it's kind of like earnings have always, to me, been about volatility skews and trying to take advantage of volatility. You know, I know that a ton of volatility is going to come out of both of these, both the call and the put in the straddle, short straddle, and I know that this May volatility is going to come out of this short position here on Friday, you know, after earnings. So, you know, I'm really looking at risk as much as anything, you know. What is my actual risk and what the stock is going to do, you know. So it's important to, you know, to feel comfortable as much as anything. And I got to where I didn't feel comfortable doing earnings plays on those, you know, stocks that already, you know, all the volatilities are 40 or 50. You know, and you may have a 70 volatility in the front month, your earnings in a stock like Netflix. It's not worth the aggravation, you know.
Well, like I've always said, you better be happy who you're going to end up married to if you wake up next to it the next morning.
Yeah, really. I used to trade Google that way, you know. I got thumped so many times. I'd make, you know, $1,800 in 2 days on a Google, and I think I got this earnings thing down with Google, and then it would go against me, you know. It would gap 50 points after earnings, and, you know, just take me out like the tide.
Yeah.
So that's it, Tom.
All right, well, thanks, Curtis. Appreciate it.
Sure.
Anybody else have any trades they want to share with the group? Maybe get group feedback on ideas of, you know, maybe how to adjust things, or just the group opinion.
Hi, this is Randy. I asked a question yesterday in the forum, and I got one answer from Paul, I think. And I was wondering about exiting these trades. I was trying to exit a bearish butterfly yesterday, and I couldn't exit. I couldn't get filled.
What were you trying to, was it on the rut?
Yeah, on the rut. And I saw the mark price go, you know, like 35 cents. You know, I was below the mark price by like 35 cents, and I still couldn't get out, or above the mark price by 35 cents, and I couldn't get out. Guess I'm selling. So I was below the mark. It never got filled.
Was that like a spread or a condor, or what was it? How many legs?
Yeah, it was a butterfly, and I was just trying to figure out if there was a better way to exit that, if I should exit it using, the verticals instead of trying to exit using the butterfly.
It's the classic trade-off. You'll probably get a little bit better fills on the verticals, but the question is, will the market move against you as you're trying to take the two verticals off, I guess.
Of course it will.
Of course it will, yes.
I mean, I don't know. The other thing you can do is, if the market's obviously trending, you could try to take the side that's going to get hurt first off, and then the other side will come off easily, but that's assuming it doesn't reverse midday in with our whipping market. You never know. So, the other thing you can do are now a couple things. Are you on Thinkorswim?
Yes.
Try pushing it to the SIBO. It shouldn't make any difference because really the only one's trading it, but try pushing it to the SIBO when you place the order. That sometimes helps. You have to do that when you create the order. You can do bet,
right.
SIBO, ICE, and stuff. Yeah, try SIBO because they're really the only ones doing the spreads. You can try that first. And then I also look at the market depths just to see what it filled at last to get an idea of how far off I am. And are any of them deep in the money? Any of the options deep in the money?
I had
Is it an iron butterfly or is it like all calls and all puts?
all puts.
So you probably got one of them that's deep in the money with a big bid-ask spread on it.
Right.
Which is why I trade iron butterflies for that reason, but it's up to you. Sorry.
Hi, Ed. This is Paul. How many butterflies are you trying to take off?
8. I had 8 butterflies on.
Sometimes a lot of times, I have an exit order in now. I'm trying to get filled in the SPX, and I've got 10. It's a 10-lot fly, so I'll put an order in for 1 and kind of fiddle around with it, see where they're filling. And if I like the price, then I'll put the rest of the order in. And if not, then I'll just wait. So you're not making a big commitment on the whole position to close it. Yesterday was pretty tough to fill. When the market's moving around like that, the market makers are now getting a little reluctant to fill orders.
Yeah, seems like it.
And
volatility has come down, but the spreads are still wide.
Right, not really.
Right.
You look at the RVIX and the VIX, that comes down, but the pricing does not reflect what the RVIX is, in my opinion. Plus you have, tomorrow is what? GDP number and FOMC number. So market makers going to keep things pretty wide until that event.
Right. Is there any opinion on what's going to happen tomorrow?
Let's see. Yellen is going to turn into a dove and fly away. They're not going to raise rates or do anything. The GDP number will come in low, but it'll be positive. And I think after the initial algos react to the news, the market will probably poo-poo it all.
Yeah, that's my feeling. It doesn't seem like there could be anything that will really move the market except them raising rates, and I don't see that happening.
Yeah, I don't either. What moved the market this morning and brought the futures down was a couple of things, but the big thing was China coming out and saying, "Oh no, the rumor that we're going to do QE is wrong. We're not doing anything." So it's all liquidity that we're dealing with. But you have to be prepared just in case, right? That's what the market makers are doing.
Right.
It probably shouldn't make any difference, but you could try breaking the order into like an order for 3 and an order for 5. But like sometimes what I'll do, like what Paul says, I'll put orders at like a nickel apart, do like one at, one price and then add a nickel to another order of 1 Z's and another nickel, and then kind of see which one of them might fill, and then figure maybe you can push the rest of them at that price once that one fills. So Another idea too. But your biggest issue is probably if you've got that call, one of the puts deep in the money, then it's probably got a bid-ask spread that's pretty wide. So.
Correct. Right. And they have no place to go either. You know, the two things: either they're busy with single orders and regular spreads, and they kind of back burner the complex orders a little bit when the market's moving around. So even if they're just not looking at it, you have no market that's interested in doing the trade. And things get quieted down, or at the end of the day, I've had orders sit all day long at a price, and then at 2 minutes after the close, they get filled. So you just never know. It's very erratic, and it depends on how bad you have to get out. What you do. If I'm closing a trade and I want out, I'll give them whatever it takes to get me out and be done with it. If I give up 1% or 2% of the profit, so be it. If you have time, then you can. That's why I like getting out of my trades. With 30 days left. If today's not a good day to close a trade, I'll wait till tomorrow. But if you only have, if you're getting out a week before expiration and you want out, you're going to have to get whatever you get and call it a day.
Another possibility, if you have a deep in the money put, and you need to, you can set up a box to close it, or, with the synthetic option. So, because deep in the money puts will have a corresponding out of the money call. So, a lot of times you can also do that if you understand the synthetics. That's another way to do it.
Yeah, you could definitely do that. The only disadvantage, I guess, would be you're still going to end up probably giving up a nickel or a dime on the synthetic side, too, to block it, but it wouldn't be as bad as the 35 cents. But, yeah.
There is another overall psychological situation in here, if Randy is trying to get out yesterday and somebody mentioned fish with one contract, and then you can see where you're going to be filled. And then you can see how much difference is that between whatever it is a bid ask or the mark, whatever the price is, and what you actually got filled. And then do the math. If you are willing to accept that profit and exit that, and then you can compare what happened the next day, because probably this morning as the market was going down, Randy says, oh, I'm glad that I didn't get out, because he probably was making more money. But right now, at this moment, as the rate is going up, he says, oh, gosh, I wish I have done this and that. So it's a lot of psychology on that, and you just have to make the decision. I'm going to be happy exiting at this profit regardless, and if you have to give 20, 25 cents to get filled, that sometimes is better, because today probably he's giving back more profits than if he had done the fillings yesterday with even a bad pricing.
You're absolutely correct. This is all about the psychology of the game and what you're willing to accept. I talked to quite a few people, and they complain that they can't, Lorette's not filling. And, the first thing I ask them, well, what price are you trying to get? The difference, the trade isn't filling because they're not giving you what you want. I can guarantee you if you give me the trade, I'll close it. You might give up 20% of your profit, but I'll get it closed. You can close the trade. It's just you're not willing to close it for the price that they want to pay. That's what the real psychology of the game is. And your bet is that tomorrow the pricing will be better, and that's the risk. But you're absolutely right. You could have got out this morning at a better price, and having waited, that price isn't there anymore, and that's the nature of the beast.
And the other thing that we've noticed too lately, I think we've talked about, is sometimes we'll have an order sitting there, doesn't fill, and then we'll say, I just want to get this thing off, and you'll take 10 cents off or add 10 cents, whatever, against yourself. And then all of a sudden it fills, but it fills for a better price than it was sitting at for the last 3 hours. So also there's a little bit of the gnawing in our back of mind is, okay, is it the order is not actually getting sent to the market, or it's just not getting noticed? And then all of a sudden you'll say, well, I'm just going to give up 40 cents, and then all of a sudden you get it and you're only 25 cents off or something. So and if you've got like 8 of them, then you could try just doing one of them at least, and see what you get for that. Or the other thing you can do is say, you know, I want to sort of get this trade-off. Maybe you take off half of it at not the best price, let the other half ride, but at least you've locked in profits on part of it, you know, or a third of it or something. So those are other ways, which works with the psychology as well. Is, you know, at least get part of it off so you've locked in some profits, and then try to work the rest of it and so on. Some other ways to do it.
You know,
so.
I don't know if this would work in this example, but I know Locke talks quite a bit about when you're trying to get your M3 position on, create the identical position in calls and also as an iron butterfly. And look where the prices are. If all three of those prices line up pretty close, then you're pretty close to the price that you're going to get filled at. But if there's a big discrepancy, you're not where the market makers are playing.
Well, that's a good idea. I mean, anything, you know, there's anything to help you get an idea of where the true fill is, to make an assessment on whether you're going to close the trade or not, is important. You know, I trade a lot of the SPX, so I'm constantly trying to figure out where they're going to fill my trade, because the mid prices are fake.
Yeah.
I put calendars, you know, I've taken calendars off and got, you know, 30, 40, 50 cents better than what I wanted. And I tried to put it, you know, I had one day I was trying to close a couple of calendars, and it was, you know, 50 cents above the mid, and they wouldn't fill. And, you know, of course I'm 40 days out, and I looked at that and decided, you know what, okay, you don't want to fill it, closing it, I'm going to buy some more. And they filled those 50 cents above the mid. 3 days later, I sold everything and made some extra money. You know, so it kind of works both ways.
Well, thanks everyone for the inputs.
Yeah. The other thing is you could consider trying iron butterflies in the future. Try an iron butterfly and see if it feels better for you, and trade that way instead of the all calls or all puts. So that's my last thing. Sorry, Tom.
Yep. Hey, Brad. So yeah, we're about an hour into it now, so this is probably a good place to stop. Great discussion, and thanks for everybody's inputs today. We'll be back again next week on Tuesday, so be careful with your trades as we have some potentially market-moving events. Hopefully it won't be too much of a problem for everyone, but just be aware of it. So with that, we'll see you next week.
Take care.
Thanks, everyone.
Bye-bye.
Bye-bye.